All right, we're live. Welcome, everyone. This is Bronson Hill with Bronson Equity doing the monthly investor series on multifamily. This is what's next for multifamily investing. So really excited about this event, excited about our speakers. If you are live here, if you can just put in the chat where you're coming in from, we'll get that chat going over there. If you're watching this on a replay, you're really going to enjoy the quality of the speakers at this event. So each of these speakers, I'm not going to go into detail about any of them. I'm just going to say, they each have, many years of experience and, portfolios of thousands of units. They're doing big things in multifamily right now. In fact, two of them are actually in a hotel, different hotels right now, looking at deals and doing events and other things elsewhere. So they are really speaking to what's happening as far as boots on the ground today in the multifamily space. So I'll give a quick outline of the event and then an intro, and we'll just jump right in here. So we're gonna get into this topic, then we're gonna do some Q&A kind of toward the end. So if you're live, you want to stick around for that, get some questions in mind. You can stick them in the chat, or you maybe wait until we get into the question portion toward the end, and then there will be a Q&A section of the chat. So just make sure you put it in the Q&A section because it will help. So I want to welcome our panelists. We have Brad Sumrok of Sumrok Multifamily Investing. Welcome, Brad. We've got Michael Becker of SPI Advisory, and we've got Feras Moussa of Disrupt Equity. So welcome, gentlemen. Really excited to get into this topic with you. And we're just going to talk about really the elephant in the room, what everybody wants to know today. Actually, today, the Fed announced they are raising rates by 50 basis points. So how do we see multifamily rates being impacted, multifamily being impacted by rising rates? Let's start with Brad on this one.
Yeah, this is a big elephant in the room. And so today where I'm at is I spent the whole day with my friends at Madeira Residential, learning from Charlie Young, who's a great friend of mine. He has, 18,000 doors, does acquisitions. So we're here talking about that. And then we spent last week with my entire team of coaches figuring out how do we adjust our underwriting guidelines, right? And so, a couple of things. Number one, I think that, and I'm sure Mike and Feras would probably agree, I'll let them chime in too, but I think it's like a temporary headwind right now. Like it's still a great opportunity to be buying with all the rent increases that are going on. But like right now, there's a headwind that we're having to deal with right now. So like there are deals that we made offers on that we lost, and they're coming back to us. There's a deal that we lost at 39 million, and the buyer that got awarded the deal wasn't able to close because I guess, rates are going up and interest rate caps are going up and loan proceeds are getting potentially cut. And so now these deals are coming back to us at 1 or 2 million less. So I think, how we're handling that is we got to be less aggressive and more conservative on debt and build in, rate increases and build in more upfront money for rate caps. The days of preferred equity. And I know just a few short months ago, everybody was hot on using maybe some preferred equity in the capital stack. And I would probably caution against that right now. And I think we're going to need to see a little bit of time for rates to stabilize. And Mike, it's interesting that we're both on this interview, but it reminds me of a time when Mike and I, Bronson, were doing a deal together back in 2016, and it was November of 2016 when the elections were happening, and there was a lot of uncertainty, and we were in a deal where the rates went.
I want you to touch base on this too. I mean, traditionally people think with higher interest rates, typically asset prices go down. Do you think, I think that's kind of a concern some people have, right? If we buy an asset now at a certain price and rates go, way up, would that necessarily lower your asset price, or how are you guys navigating kind of projecting the next 5 years?
I mean, I think in the immediate term, it's a pretty healthy headwind. The debt terms are materially worse. It's just you're getting constrained with your underwriting, so it's just causing lower loan to values. The lenders being a little bit more selective on who they loan money to, and so it's just a little in the immediate term. I think a headwind. hopefully after today's announcement, it'll hopefully get a little bit of stability, or at least the start of some stability, because it's been a little choppy last handful of weeks, to be specific and topical. So I'm hopeful that they took the 75 bip hike off. It seems like they're going to do 350 basis point hikes instead of the 4 that the market had priced in. So the stock market rallied immediately after, and then 10-year treasuries down. So I think it's probably the next 12 to 18 months are a little choppy. But if you look at the fundamentals of kind of the Sunbelt multifamily, let's just put it that way, anywhere the on markets the last several years, I mean, you're still seeing tremendous in-migration. They're not building enough housing supply. The single family market is pretty challenging. So I think if you can navigate the next 12 to 18 months, I think you're going to be glad that you did. But it might take a little bit of the sellers kind of giving back a little bit on the prices in the interim to compensate for the terrible debt terms relative to 2 or 3 months ago.
All right, thanks for that. Feras, why don't you talk to us a little bit about your perspective on this as well, and kind of how it affects short and long-term approach, and just, necessarily kind of that negotiating with sellers. And obviously the sellers are looking, back, saying everything's perfect. We're getting this amount per unit, 6 months ago, and buyers are looking forward, seeing some caution. So how is that kind of process going, or how do you see that going?
Yeah, so it's kind of interesting where things are at, right? I guess my answer is a little bit of a hybrid of Brad's and Michael's. And so, we have 6 deals in escrow right now, and we are absolutely seeing just the differences, right? And, on smaller deals, you're seeing a really wide spread, right? Versus what we expected versus larger deals. We are surprisingly actually very competitive where we were 6 months ago. And so I think ultimately, with today's news, I'm hopeful because we have 2 deals we're locking in over the next week or two. So hopefully rates go back down. But I think, I guess for me, the long-term outlook still looks great, right? I mean, it's amazing if you just factor in the inflation and with that, the corresponding rent growth that you get, if you hit 5 instead of 4 or 4 instead of 3, I mean, it still has a very strong impact over the next 5 years on some of these plays. And so similarly to, I think, Michael, I think overall, I'm still bullish, right? I think it's going to be choppy, right? And you have to model that in. And I think the one thing a lot of people don't talk about too is if you're doing floating rate, right, you have to buy your interest caps. And interest caps are the things that have been really interesting how expensive they've gotten, right? They've tripled in price pretty much over the past 3 months. And so that's another thing that I think buyers need to plan for. And, on our side, I think the last thing I'll add is just a lot more reserves than what we did previously, right? Because kind of you don't know what the future holds, especially if you're planning to do a refi, and just kind of going into that correspondingly with just plenty of cash just to support what we need to get done on the back end.
Yeah, no, that makes a lot of sense. Having more cash, being more flexible, and those interest rate caps are definitely getting more expensive. We're seeing that as well. Let's Michael, let's talk about this real quick. I know you guys are doing a lot in Texas. I'm not sure if you have other markets you're doing as well, but can you talk to us a little bit about what it's looking like to find deals right now? Are you finding it's getting easier than it was 6 to 12 months ago? Is it getting harder, or is it the deals are out there, it's just hard to kind of get to the negotiating table to actually make that work?
So 6 months ago, I thought it was a little bit easier because we were kind of, call it third quarter or fourth quarter of 2021. There was a ton of inventory out there. So you just had a lot of opportunity. A lot of people kind of brought forward some of the deals that would have been out. And then I think you go into the January, February of 2022, there's virtually nothing on the market of any real note. I mean, very limited inventory. And so kind of felt like there was almost like a GameStop short squeeze kind of mentality going on in January and February, because the debt markets were still pretty liquid, and just wasn't much inventory, a lot of capital chasing it. So I think we kind of got a little ahead of ourselves in January and February with some of the pricing. So I think that's kind of blowout top is maybe kind of a little bit of steam's coming out of that right now. So there's a lot of opportunity out there, a lot of people, a lot more sellers today than there was, in January or February. But I mean, I think we're seeing kind of a little bit of a disconnect with the bid-ask spread between what the sellers want to get the price from January, or maybe they're kind of off it a little bit, but the debt's just a little challenging. So I think we're really just needing the debt market to kind of calm down. And I think one thing to kind of make sure I point out to, Brad referenced this transaction we did in 2016. And, we ended up doing a Fannie Mae 12-year fixed rate mortgage, which, went up, I think, maybe 80 basis points from the time we agreed to it by the time we actually ended up getting rate locked. So we ended up rate locking kind of the high 4s, if I recall correctly. And we sold the property last year, made a bunch of money. But fixing it is not just a no-brainer, even if the rate cap is there, especially for those of you that are relatively new in the business. These longer-term mortgages tend to come with large prepayment penalties, defeasance, or you'll pay tens and tens of millions of dollars, and you'll maintenance and defeasance prepay penalties. So I'd make sure you watch out, because it seems like this is probably a temporary spike, and maybe paying an extra 1% or 2% for a year or two in interest is a hell of a lot cheaper than I think the 23% prepay we had on that mortgage when we paid it off.
Right. No, that's definitely something a lot of people are looking at. We're doing a lot more of the flexible debt with interest rate caps versus doing the long-term, Fannie Freddie stuff. That we had to pay a pretty hefty fee for selling something late last year, which was really painful. A lot of people think of real estate as being, how is it? I'm sure they tell you this too. How's real estate doing? And real estate is not only is it it has many different assets within it. Just for those watching, you've got single family, multifamily, you've got self storage, you've got in the city, out of the city, you've got farmland, you've got all kinds of different things. And so, what geographic area you invest in can really help you, or it can really hurt you. So in 2022, Brad, why don't you talk us through maybe areas of the country that you see are good areas to focus on and some of the reasons behind that?
Yeah, I mean, look, so first I'd like to just say, like, what makes a good market, right? And then I'm going to talk about the ones that I'm most bullish on in 2022. But for the past 20 years, I've been looking at markets that are landlord friendly, business friendly, that have population growth and job growth above the US average, that has a widening affordability gap. And by affordability gap, I mean, what's the price of a median home cost? And what's the price of that medium apartment unit cost? And there are some markets where, maybe you could buy an apartment building for, 40, 50, 60,000 a door, but a single family home costs 75,000. So the people there are going to be buying single family homes, right? And so when you bake all those things into it, plus the availability of apartments, the supply and demand imbalance or surplus that's happening in these markets, that's what I really look at. And when it comes down to it, there's for the past several years and for the next several years, I think there's just some markets that are going to stand out above the others. And in the big picture, it's the Sun Belt, right? It's like everything from Vegas and Arizona down through Texas, over the Florida and the Carolinas, and a few pivots and a few distinctions that I'm seeing in the market. For the past few years, the Texas markets were like number one. There was the Texas Triangle, Houston, Dallas, Austin, San Antonio, and that's still in my top 10. But right now, what I'm seeing is the Central Florida corridor is just outperforming. And I have assets in Tampa and St. Pete and in Jacksonville, and these rents are just going through the roof. So like for me, number one is basically your Tampa, Orlando, Jacksonville area. And then another market in Florida that I've overlooked and always considered too expensive, but South Florida is just on fire, and the population growth there and the job growth there is just killing it. And just like Austin, Texas, I regret not buying anything in Austin, Texas. And there were so many deals I looked at in Austin like a decade ago and I thought was too expensive. And I wish I would have just bought some of these deals. And it's the same thing in South Florida. So Florida to me is number one. Arizona, especially that anything in between Phoenix and Tucson has just been hot, and it continues to be hot. 3, the Texas Triangle is just continuing to outperform. I'm really bullish on some of the areas that are landlord and business friendly in the Rocky Mountain region, places in Utah and Colorado. And then, of course, like the Carolinas, Atlanta, Tennessee, Nashville is like a great market right now, and there's a lot of activity going on in Nashville. And then I also like to look at like maybe some smaller tertiary, smaller secondary or tertiary markets that would be considered emerging markets, and maybe these wouldn't be like on the national landscape for some of the larger investors, but it's some of the places that I like to look and guide people into. And again, I'm looking at all the same factors like rent growth, employment, occupancy, cap rate, business friendliness. And so smaller markets as well. I mentioned Savannah, Reno, Omaha, and maybe places like Pensacola, Florida, Greenville, South Carolina kind of fit the bill for for some of those smaller areas. So hopefully that answers your question.
Yeah, that helps a lot. No, just the idea of buying where the growth is happening, right? There's a lot of population migration, and so we do a lot of work in Jacksonville, Florida. We've got about 1,000 units there. We're seeing average, kind of 70s vintage average rents are about $900. We're taking over for these properties, and we're seeing our comps of post renovated units are about 1425, which I just don't know anywhere like that where you can see like a 50% rent upside on. I mean, it's kind of crazy. So, and obviously some of this is inflation, some of it's, migration, there's all the other things, but being a landlord in areas where you can raise rent is really positive. Feras, you said you have 6 deals currently in escrow. That sounds like you're pretty busy, and obviously you're in a hotel and you're going to work on some of that stuff now, but talk to us a little bit about kind of what changes do you see happening to multifamily either right now or over the next few years, including just housing migration, property tech, interest rates, anything that you're seeing that you just think is really important to take note?
Yeah, so I mean, a couple of things. Maybe the immediate future, it's really what Michael said. You're seeing there's a lot of pricing discovery happening, both in debt and even on the acquisition side. And, I mean, literally the past 2 weeks, our phone is just blowing up with brokers, reaching out, just basically seeing, I mean, we're seeing 10% price drops across the board, right? That's probably what I'd say average. I mean, the deal that was, guidance was 55, now they're begging us to do 50, right? And we're seeing that multiple markets, anywhere from Texas to Atlanta is a big hub of ours, in Florida as well. And I mean, there's not really a market out that I have not seen a decent price drop across the board. So I think in the immediate future, I mean, there is opportunity right now to probably pick up some assets if people are out there looking, but you're going to have to navigate the debt side of it, right? And so the other thing Brad mentioned, I'm glad he mentioned is Sunbelt, right? I mean, we just launched a portfolio. We literally called it the Sunbelt Diversified Portfolio. We like the Sunbelt. We've looked up and down it, left and right. And, again, it's got a lot of the fundamentals that we look for. And so I think there's just going to be continued growth in those markets, right? Both on the acquisition side as well as the tenant side. And maybe, last but not least, I think inflation is here to stay, and it's kind of interesting to see, how people capitalize on that, right? Because ultimately, there's kind of 2 schools of thought, right? And I think this is the elephant in the room, which is, okay, there's rising interest rates. What happens to cap rates, right? And correspondingly, what happens to pricing? And ultimately, at least my philosophy is, with inflation, you are seeing big changes in, rents across the board, right? From the non-renovated assets to the renovated assets. And, we have a deal that we bought a year ago, and we're getting 36% lease trade outs without doing upgrades on the interiors. I mean, that is just, if we just did nothing and ran it for a year, I mean, that's significant, right? And most of us, I'm pretty sure everybody on this call doesn't model more than 4%, growth, right? 4 or 5% growth. And so something like that is a fundamental shift. And so even with interest rates going up, right, the actual amount of rent that got absorbed in that time frame, right, really helps offset kind of what ends up happening with cap rates and valuations. And so I think it's kind of interesting to really think through all these different things and how they all impact each other. And, ultimately, at least my philosophy, the long-term outlook looks good. Just making sure there's no, surprise black swan event that really kind of shifts perspectives, right? But ultimately, right now, replacement costs are going through the roof, right? You talk to some of these developers, and I mean, construction is getting really high, right? So with inflation means construction costs get higher. And so you have to always look at, okay, I can buy this asset, I'm buying it for $200 a foot. The guy building it down the road is costing $350 a foot, right? And so how does that impact my valuations and where things go? So I think there's a lot of different factors to kind of evaluate. And I think none of us, are economists, but there's just, it's interesting to think through what channel of thought that, you want to believe into, right? And kind of buy into it and then build your business and your strategy around that.
Right. So I appreciate you sharing that. I mean, I think we're all multifamily guys. I'd imagine that all of us has the highest majority of our net worth in multifamily investing, because it's what we do. We don't just sell it. We believe it. We live it. We put our own money into it. That we're in a different landscape. There was a 2-year period between February of 2020 and February 2022 when the currency, the M2 money supply, increased by 40.9%. So you have all this new money out there that has to find a home, right? It's got to go somewhere. And we've got housing shortages, we've got other things. So the question I'd actually love to just ask and see, because obviously we're all bullish on, I'd imagine we're all pretty bullish on multifamily, but for somebody who's an investor who's watching this and saying, well, what should I do? How should I allocate my resources? There's kind of two schools of thought. One is, if I hold cash, inflation may actually really be like 10 to 20%. I mean, much higher than what they're stating, which I think it is, probably between the 10 to 20% annual range. So you're losing, if you have 100K in the bank, 10 to 20K, you're just sitting in the bank versus getting it into an asset. But if there is, rates continue to rise, there could be some deals available, some stuff that's not available now. Is it wise to have some cash available? And maybe for each of you, how much cash are you having available for a rainy day if rates go higher and valuations, kind of get,
the values we're kind of seeing just didn't make sense. We said, well, let's sell it instead of owning it. And we did it on a handful of deals. So I don't think having cash is necessarily a bad thing. I mean, I think I have a little bit in the stock market and just recently, and I hate every minute of it. So I'm pretty binary type of guy, right? Either own apartments or have cash. There's not much in between. And so I kind of want to have risk off my money. And then when I want to put risk on my money, I'll go do a deal with the expectation of making, outsized returns on what I put in there. 15+% kind of historically is what we pro forma'd and, delivered well north of that, just because we've been in a pretty good environment. So I think having a little bit of extra dry powder is not too terrible. But I mean, as Feras is kind of mentioning, I think we're starting to see a little bit of price adjustments, and maybe this is just kind of getting back to where pricing was in December of last year, after the kind of the blowout top of January.
December's
February.
Probably the right time frame, how far back it's going. Yeah.
Yeah. So, I don't think we really gone past where it was like in December. So it's not like we've really seen a major retracement. And to his point too, I mean, I think you just look across the entire portfolio, and we're in Dallas, Austin, San Antonio. And I mean, we're seeing probably, call it 17, 18% average trade out. So we own majority Class A multifamily. So it's not like I'm doing a value add program on some 70s deal and getting a lift by doing some work. This is all organic trade outs. And, like you said, we're underwriting 3% in our model and getting 18%. So, we're 6X what we think, and we're not doing any work. Obviously we have, especially in Texas, having the pressures with property taxes and payroll and insurance and things like that. So, it's not all to the bottom line right now, because we certainly are getting some headwinds with taxes for sure. But I don't think cash is necessarily a bad thing. And if we do see a little bit more opportunity, I think it's going to be relatively short lived. I mean, so it might be a 6 to 18 month range, maybe somewhere in that kind of ballpark. And then it's going to be game back on. So I think those that are, we bought several deals towards the end of 2020. And it was kind of nerve-wracking at the time, but certainly glad that we did. So maybe we find that opportunity here. And those that have deals, you just need to fight like hell and hang on, because I was a banker in 2008, 2009. And those are the people that were able to hang on, got considerably higher valuations, in the not too distant future. So I think really just setting your deal up fundamentally smart, where you can weather a lot of storms. And as long as you hang on, I think we see the demographics and everything that's coming out the housing market. I think you'll be, considerably richer in 5 or 7 years from now than you are today, even if you buy a little overpriced deal today.
Right. That's really a great approach. Yeah. Just, what the available options that are there, having some dry powder. Brad, maybe you can touch base on that as well and give a little more color as far as, within multifamily, as well as kind of how much cash, should someone have. Obviously, we're not giving anybody any specific advice. Are you, fully putting everything that you have out? Like I know Grant Cardone, one of your friends, talks about continually going broke, like putting all your money into different things. And I think there's some validity to that. But how much kind of dry powder does someone in general need to have for a rainy day when, things look a little different in the future?
Well, I believe that's all personal, right? But like I tend to agree with Grant in a lot of things. And just like Grant, we have an apartment investing business, and then we have a real estate education business. And so all that income that we make from our events and mentorships and masterminds, that's all taxable income, and it's a significant amount. So what we did last year is about 80% of everything that we made from that business and our brokerage business and any kind of sales proceeds, Mike and I sold a couple of deals, Mike, and we got capital gains, right? So I got all this income from all these multiple sources, we put about 85% of that back into deals. So like last year, and I hope I hope it's okay that I share, but like last year, we put like $8 million of our own money back into about 3,000 doors. And so what that does is, the cash returns are skinnier, but those deals, and we're on the GP side, so we're not only going to make a return on our money, but we're going to make carried interest in those deals on the GP side, and then we're not going to pay any tax again this year because 2022 is the last year where we're going to get the best bonus depreciation available. Those tax laws that changed in 2017, that bonus depreciation is still here in full force through the end of 2022. And then it starts to phase out in 2023. It'll still be really good, but not as good as it is next year. Won't be as good as it is this year. So like anybody that invests this year is going to get the most amazing, bonus depreciation that it's available between 2017 and now. So like that being said, like 80% of my wife and I's net worth is in multifamily, but I would say, we do have money available in cash because I want to be able to make plays and make moves and make investments. But part of that is because we have multiple streams of income from, we're constantly, am I a net buyer or net seller? It's probably about even because we're selling deals, but just as many deals we're selling, we're reinvesting most of those proceeds. I like to go to a lot of events and invest in, I like to invest in, personal development and growth and masterminds. I like to invest in people. I like to invest in things that are going to buy back my time as well. Like most people, when they think about investing, they think about, well, should it be in real estate or in commodities or stocks or gold or Bitcoin or whatever? But I also like to think of investing in things of like, what could I invest in that's going to give me back some of my time? So like with our business, it's like anything that I'm doing that I shouldn't be doing, or I could hire people to be doing. We're investing in that. We're investing in people. We're investing in ourselves. And then I guess I could say, I didn't create this term, but like all of us here probably have a little bit of, what's referred to as like FU money. And, and we invest in things like, I would say like 80% of ours is in multifamily and maybe 5% is in like high risk, high reward type of stuff. And 15% might be in cash, if that answers your question.
Yeah, no, that's great. I think it's something that like it is a very personal question. I used to be an investment advisor in the past, and it's something that you really can't advise people. Obviously, we're not giving any specific advice, but I think it's always helpful to hear from people that are successful of how they are allocating their resources these days. So I appreciate you sharing that. And you mentioned one of the awesome benefits of multifamily are the tax benefits. And for that reason, with inflation, with all the tax benefits you get this year, it goes down from 100% to 80% in January of next year. So it's just like to be able to take advantage of those deals now, I think is really huge. Feras, can you talk a little bit about what you see passive investors should be looking at when they're looking at a specific deal? So some things to maybe look out for, or some things that, just to be aware of, things of like, when I underwrite a deal, we try to make sure we do this on a conservative level. And again, everybody uses conservative, but then I know all of us see a lot of deals and we look at it and we're like, gosh, these assumptions are just kind of really hot here or whatever. So what are some things that you kind of, I guess, passive investors should be paying attention to right now?
Yeah, you bet. So I'll maybe answer it with something kind of related to the elephant in the room and then back into some of the obvious answers, right? I think the first thing that investors need to think about is really how much cash on hand, right? Because ultimately, I think we all agree there's some choppiness in the market for the next year. So all these deals need to get past that. And, for the deal that is going in with a floating rate debt and they plan to go do, value add and a refi after, right? You may be 2 years out and you need to be able to get out of the loan that you're in and get into something. So for us, one thing we've really shifted as we've grown as a company is how much reserves we have sitting on the sideline. Just parked there, we're okay presenting a lower return in term, for the sake of just having a much safer investment. And I think very few investors really poke and see how much in reserves is actually being planned on the deal. And, how does that correspond to CapEx, right? I think a lot of buyers lump CapEx and reserves together, right? But you really need to think about them as two different things. And is there an off ramp that, if things start to shift in terms of you didn't just blow your money on the capex on one thing, but you have the ability to adjust kind of based on what the market is. So I think that's a big one, and that's something that we've really been thinking a lot more about over the past 6 months or so. And how much we have sitting sidelines. The other obvious things, I think, the biggest impacts to any deal, right, is really what is the exit cap that's being looked at, right, relative to that market. And and I like to say relative to that market, because you see some people that'll say, I'm buying it, if I'm buying a deal for a 1 cap and I say I'm modeling a 2 cap exit, like, yeah, I doubled the cap, but I mean, that's not realistic, right? I overpaid for the deal, and the market is probably not 2 cap, right? Even here in Austin, Austin's hovering in the 3s. And so I think just looking at the exit cap people are looking at, and then looking at what are the actual 2 factors. What are the what's the rent and expense growth that they're modeling in? And then last but not least, I'd say it's really what are the rent pops they're looking at doing, right? One thing I think that's shifted in the market is for a lot of deals right now, and I think Michael mentioned, right, he's focusing more on kind of nicer assets. Right now, the value add that we are doing is really loss to lease. That is the biggest value add most people are doing. We are taking assets, right? We are letting the loss to lease burn off. And so you really need to start modeling in what are the rents that are being achieved based on the last 10, last 20, last 40 leases of that asset, right? So you can get a real good pulse onto what the deal is, because you're seeing kind of a big discrepancy between effective rents, right, which is the average in place across the whole property, and then effective of really the last month or two. We're seeing $200 spreads in a lot of these assets, right? So if we just did nothing, $200 are made just burning off loss to lease, which is separate than also what market kind of rent pops can be done. So I think as an investor, I think the first question is, make sure you're investing, like Brad said, in markets that you like, right? Job growth, population growth, landlord friendly, right? Just kind of the obvious things. And then with that, find investments that match your investment criteria. Maybe you do want to go into a much safer, investment because you are nervous of the market, right? You want to be in newer deals, better locations, much higher cash reserves. Maybe you want to kind of go in with a value add play because you're looking to maximize dollars. And so it's different strokes for different folks. And I think similar to kind of the allocation question, some of this is a personal question, right? But it's ultimately finding assets that match the criteria of what you're looking for.
Yeah, I think that's great. I think, like you said, cap rates, rent growth, I think those are essential, not to be too lofty on your assumptions. Just for our audience today, we're going to, if that's live, we're going to be doing some questions here in a few minutes. So if you have some questions, you can start putting those in the Q&A section of the chat. There's a Q&A section there. You can start putting those in. I did want to ask Michael specifically about, I know you're doing a lot more of the Class A type tokenization or other sorts of prop tech, kind of making these assets more efficient or just perform better.
Yeah, I'm not so sure about tokenization, so I really can't speak to that. But I think on the prop tech side, you're seeing, all the software and even like the AI is getting much better. So a lot of this is really just kind of helping eliminate on-site personnel, or what the job an on-site personnel person would historically have done, and kind of taking that in more of like a centralized place, and ultimately should help drive payroll costs down. So as we're seeing some inflationary pressures with payroll, just by your wages going up, I think that's a good way technology help kind of offset probably at least in Texas, your second biggest line item, which is payroll. Behind your property taxes, that is certainly something that's kind of been helpful to do that. Plus, just kind of the, if you think back, a little bit over 2 years ago, it was really uncommon for someone to lease an apartment unit without ever putting eyes on it. Now these people lease these units virtually off your website, sight unseen. And the first time I see it is when they showing up with a moving truck and all their stuff. So it's amazing to see kind of what's really evolved through online leasing and a lot of the online platforms versus just a little bit over 2 years ago when that really wasn't as big of a thing. So I think you're just going to see more and more efficiencies on the management side, which hopefully will help drive down payroll costs or maybe be a little bit more preventative of some of the maintenance things. You're seeing that kind of continually evolve. As far as tokenization goes, I don't know that much about it, but I think the idea is that maybe if you get kind of like the blockchain, put this out there, you can sell off little pieces of your real estate in real time, or maybe disrupt the title insurance racket that is, at least in Texas, a really expensive transaction cost. So if that can be put somehow on the blockchain and kind of secure or guarantee the title is perfected that way and avoid, 6 figures of title policy premium, that would be certainly welcome from this guy.
Yeah, no, that's great. And the reason
maybe,
go ahead.
And I was going to add on that point, and Brad and Michael, I mean, are you guys getting? There's a ton more companies there, right? I think all of us are in CoStar's database of people to call and email, right? And I don't know about you guys, but I'd say the past 3-4 months, there's been a huge influx of just random companies I've never heard of reaching out and asking us to, demo, try, and go check out their cool way to solve every problem known to man.
Oh yeah, my phone rings. One of the biggest mistakes I made when I started out is I put my cell phone number out on a couple forums here or there, and all of a sudden people call me all the time, and so just don't answer unknown phone calls but yeah, constantly getting pitched by this new idea or that new idea. Yeah. So there's a lot of options coming at the space that just weren't contemplated just a few years ago.
So we're going to jump into questions here in just a minute. I was going to go somewhere else with that, but I think we will jump into questions. But I was going to mention this. There is a conference coming up called Blockchain and Real Estate. It's actually in Austin, Texas in September, and I'll be moderating a panel there. There's a guy named Michael Flight, who some of you may know, who is leading that up. So I think there was a couple hundred people last year. I'm planning to go to check that out. So very interesting idea. So we'll jump into a couple questions here. If you do have questions, you can go ahead and drop these in the box, and we can kind of just freewheel it here. Can you talk about, this is from Chris Collins, can you talk about exit price per door? It seems like rising rents, burning loss to lease, and cap rate compression will certainly raise values, but similar to the idea that rents can only go so high, is there a similar problem with exit price per door? Can properties really go up and up and up? As buyers, what do you think?
I mean, I think it's just math, right? It's going to be what buyers underwritten NOI is, what the kind of market cap rate is, what kind of debt they're going to get, and kind of what the market expectation is for levered returns and multifamily. So I don't think we're really necessarily constrained, because if you would tell me that there's some 80s deals, and I bought my first deal in 2013, Dallas, Texas, the investment costs have escalated pretty dramatically. So the new brand new stuff that's coming on the ground, getting leased up, have to charge materially higher rents to make the math pencil. So this kind of that gives you a little bit more headroom to push. And I mean, Austin, Texas, which we own 5 deals in Austin, I mean, that turned into above replacement cost market all of a sudden last year, where it's always been kind of historically below replacement cost for some older deals, and that certainly flipped. And that was not the case for the majority of my lifetime and knowledge of the business.
Yeah, right. I'd say the replacement cost, I think, is the biggest thing to that, right? If you're modeling an exit that is essentially below where you think replacement costs are, you're probably doing it wrong, right? Something you're getting too aggressive, because ultimately you have to put yourself in the buyer's shoes, right? The person you're selling that deal to in 3, 4, 5 years, if they could buy your asset or buy a newer asset down the road, essentially at a better price point, would they buy your asset? So that is something to think through. But I think it's a math equation coupled with where you think replacement costs are going to be.
Yeah, my 2 cents is like Mike said. I mean, my first deal in 2002, 30,000 a door. Interest rates back then, by the way, were 6.35%. Imagine that. And I thought that was a good rate, by the way, in 2002. But rents were only $400 a month. Now that property, the rents are $1,200 a month. Interest rates now are what, 4.5% on that deal, which seems like a bargain. And but that property would sell for what, 120 a door. And so I would, like Mike said, I would have never expected that deal to ever be worth 120 a door. But looking forward, I mean, I just feel like if you're in the right market, with the characteristics of what makes a great market, that there's so much more demand than there is supply for multifamily right now. I mean, I don't look at it that way anymore. I don't really look at oh my gosh, because, I used to think that, just like Mike said, I used to think, man, could I really take this 40,000 a door and sell it for 60,000 a door? Is that even possible? And but with the way they're printing money and the way inflation is going right now, I think I don't really see a cap, so to speak, on an exit price per door basis.
Right. And I think that's something a lot of people, we all want to buy low and sell high, right? That's kind of the pattern we want to do. But with so much new currency in the system, I don't know that there's necessarily a going back to normal. And if you just look at like local single family housing prices, I imagine in your neighborhood, wherever you live, we've had stuff that's tripled in the last 6-7 years in LA. I mean, it's crazy. And I think that's kind of all over the country. We're seeing that kind of stuff just because there's no place for all this money to go. So we'll go on to the next question here. Again, if you have a question, go ahead and put that in the Q&A. We'd love to hear. We do have a little time for questions here. What is the preference on the debt structure in terms of fixed versus variable rates, and how are you currently underwriting deals? So I think that's something that's really interesting to look at. Michael talked about the yield maintenance. If you sell early on a longer fixed deal, what are some factors, and particularly with syndicating, where you likely want to refinance within 2-3 years, or if you're going to hold for long term, maybe someone can kind of talk about the factors that go into what type of debt you choose.
Yeah, like I said, I made that mistake many times, so I'd just be careful fixing in a rising interest rate environment. Especially, it seems like, I think I heard a stat, the longest has ever been from the first rate hike to the first rate cut in recorded history of the Federal Reserve is something like a little bit under 3 years. So you think this is going to go on forever and ever, and it just doesn't go on forever and ever. So as soon as they made their first hike 6 weeks, 8 weeks ago, whenever that was, they're on the clock to cut. So, worst case is going to be 3 years. So chances are it's probably going to be, something south of that. And if you get yourself stuck with a yield maintenance or defeasance prepay, you're going to handcuff yourself to the deal, or you're going to set a bunch of money on fire to get out of it. And that's the voice of experience. I can tell you that. Got that battle scar. So I just be careful with it. I mean, I think, right now, so that leads you to kind of floating rate mortgages, or maybe a mortgage with a step down prepay if it's fixed, or it's hard to get into the 60s, so a lot of this stuff is just kind of in that half down, and it's making stuff a little bit tough to pencil.
I agree with Mike on that one.
That's it. No, Sam, and I think my favorite debt 6 months ago was a floater with a really tight cap, right? Where you buy down the cap up front. Now caps have gotten really expensive. And so, for those that don't know, a cap, essentially you're mitigating your upside risk, right? Caps have gotten a lot more expensive. And so it's hard to buy a really tight cap because, I think buying a tight cap kind of gives you the best of both worlds, right? You're getting into that deal. And, if there is upward pressures from rates, you're protected, right? But you can make those exits whenever you can. But right now, I think it's, similar to Mike. I mean, we're still using floating rate debt. It's still very attractive. And similarly, we've all burned millions of dollars paying prepays. And so I think it's kind of a balancing act, and just getting into debt that is longer term and still having some of that upside risk kind of mitigated, right? Making sure you have the reserves to kind of help handle that.
Yeah, no, I think that's great. I hadn't heard that, Michael, that the longest between when rate rising starts to when they start cutting is 3 years. That kind of gives you a little window on, in general, how that will look. Obviously, things.
I think the average is less than 2 years. So we all think this is going to go on forever, but this market always changes. That's one thing I've learned doing this long enough. Everything's always changing, always. So, whatever it is today is going to be different a month or two from now, whatever way. And that's what I think that's kind of separates the better operators from the worst. You just have your finger on the pulse, and you're quick to adjust when the market adjusts.
Yeah, absolutely. Brad, any thoughts on that, the fixed versus variable?
Well, I mean, we're still underwriting variable. Mike and I just talked about it. I called you 2 weeks ago, and we talked about how we'll exchange notes on how we're underwriting deals. And Mike shared something with me a while ago. And Mike, I think you have the number, but was it like 89% of the time historically, like a variable rate loan is going to end up being cheaper than a fixed rate loan?
I think it's like, it depends on what your time period is. So I think over a 10-year period, back in recorded Fed history, going back 50, 60 years, over a 10-year period, it's always cheaper to float. You're always better off to float. You get within like a 1 or 2 year period, where maybe you're better off fixing. But if you get to like the 5-year period, I think it's something like north of 80, like almost 89%, you're to be better off floating versus fixing. So it feels really terrible right now as we're all getting kicked in the teeth by Jay Powell. But, it's a temporary thing. And like I said, I think they'll be cutting before you know it, because there's just too much systemic debt out there. It's just not going to work if they go to the moon. And he's already kind of tapered off today what the market was expecting. So, again, you got to be prudent. I think Feras is right. Get more cash. I think cash will solve a lot of future problems. Make sure if you're a sponsor, don't over distribute. We're going through, I got to go through all my math here the next day or two, because we reforecasted every one of our deals that had a floater. Looked at if we had to replace the rate cap. When does the rate cap come up? What's my maximum exposure? What am I paying out? Am I over distributing? Do I want to cut my distributions? And just get ahead of it a little bit. And some of your investors might be pissed at you because they've been getting, $1,000 a month, and it's going to go to $500 a month, but it is what it is. And it's a lot better than asking for a check in a year because you paid all the cash you should have been keeping. So, I think just being proactive will go a long way, and making sure you don't get yourself in a real big problem and several months down the road.
Yeah, I think that's a real gem. If people watching on this on the replay, or if you've missed that, that floating cap rates, you'd be better off, historically 89% of the time. I have a lot of investors that just, have resistance, or what does that mean? And what happens if things rise? But it's usually a shorter duration. And we're obviously in an asset that's very highly demanded. We've got one more question. If somebody doesn't have any more questions, we'll just kind of do this one question, then we'll kind of go ahead and wrap. And we've got a couple exciting announcements here. Actually, this one's related. We'll just touch base on this. This is about the interest rates, the rate caps as well. Can you explain how you're forecasting how much cash you need to underwrite to take care of the gap between your going in rate and your interest rate caps? Are you assuming you will hit the rate cap for the term of the whole?
They're pretty entertaining. He's got a podcast called the Rate Guy Podcast. So those are all, he writes a newsletter, a little commentary. But on his website, you can find the forward curve. You can buy, and you also find the rate cap pricer. So you go in and put whatever the loan amount is you need to buy a rate cap on, the strike on SOFR or LIBOR or whatever your index is, and then the term that you want to buy it for. And I can tell you how much it costs today. And then they also have the forward SOFR curve. So it's the market's expectation of what SOFR is going to do 10 years in the future. So we're going through and modeling, okay, we have a 200 basis point spread or 2% spread over SOFR. And SOFR just went to 80 basis points today, essentially. So my next mortgage payment is going to be at 2.8%. And then, it's projected in a year to be at maybe 300 basis points from 80 to 300. So my rate would be 5%. And then that's kind of what we're shocking forward into our models. And at some point, your cap will kick in and cap the amount that SOFR can go to. And then to Ferris's point earlier, if you have a 10-year mortgage, the lender makes you buy a 3-year rate cap and then escrow funds for it. Well, if you're escrowing off of what the rate caps cost a year ago, you're dramatically under escrowing what it would take to replace that when it comes up. So we're going through seeing what the rate cap costs are, today, looking at what our escrow is, what's our shortfall, what's our rates going to be relative to kind of our projected cash flow, what we're paying out, and how much cash we have in the bank, and seeing if we have any real problems, right? And if we have some problems, we need to be cutting our distributions today to make sure we have cash to deal with these problems in the future. So that's kind of what we're reforecasting every deal in real time. That's kind of the basic, simple methodology that or maybe not so simple, but that's the methodology we're going through to make sure we don't run out of money and have to go knock on everyone's door for another check.
Yeah, that's the most critical thing. Is
one thing Michael said like 5 times, and I want to point this out because to me this is another gem: reforecasting. Right? I think in a hot market like it's been, people kind of forget that you should probably continue to evaluate your cash position, your escrow, and everything else. And right now with being in floating rate debt, right, things getting more expensive, and even simple things like taxes, insurance here in Texas, right, you need to be smarter about that and get ahead of it, right? You don't want to be the guy at a year later saying, hey, we over distributed too much, we actually need to take back money, right? Nobody wants to hear that. And so I think the smart investor is the person that's kind of taking a pause, evaluating kind of their portfolio and making those adjustments up front beforehand, not 12 months down the road whenever it's a much bigger problem.
That's great. Yeah, absolutely. Planning ahead and making sure you got that in your evaluation there. We're going to make a couple announcements at this point, and we're going to kind of come back for the last little part here. So I'm going to do a screen share, and I'm just going to show you this. This is our next event coming up. This is called Your Best Inflation Moves. And this is going to be June 1st at 4 p.m., 4 to 5 p.m. We do events like these, either on multifamily or other aspects of investing. And then we talk about inflation. So we've got Robert Helms, and we've also got Dr. Chris Martinson over here from Peak Prosperity. And then we've got a third person who I can't announce yet, but I think you're going to really enjoy that. So I'm going to put this link in the chat here in a minute. So I will put that in there for you. Also, if you enjoyed this conversation, we do have a podcast called The Mailbox Money Show. We have lots of great interviews about passive investing. You can check that out. This will also be up, as well as a lot of these interviews that are done on YouTube. So this is just Bronson Hill, and this is where you can find all of these replays. This replay will also be sent out to you later as well. So I'm going to put this in the chat there. This is going to be June 1st. And Brad, I believe you had a gift for everyone just for being here today that you wanted to tell people about and give them some free, basically a free event that's a pretty high value.
Yeah, I mentioned the two businesses that I'm in is owning apartments and helping other people invest in apartments. And every a couple of times a year, we do a 3-day weekend event. We call it Rat Race to Retirement, because what I teach is how I was able to go from the corporate rat race, like Robert Kiyosaki says. And to get out of the rat race, you need to have investment income that meets or exceeds your W-2 income, so you can leave the rat race. And I was able to do that in less than 3 years. And so that's what we teach. We teach how to find deals and fund deals and fix deals and close deals. And it's a 3-day event. And I want to go ahead and post in the chat box a link that anybody watching this could attend virtually 100% free. So I will post that in the link. Again, it's May 13th, 14th, and 15th. And did that show up in the chat box? Let's see. Am I in the right place?
Looks like we got it in the Q&A there, but I'll move it over to the chat, so we'll be good here. I can just drop it in the chat. Oh, looks like you can be in here. Encourage you to make the event in June on inflation. We're going to talk about some really exciting stuff. And, all of us here do multifamily deals. So if you're interested in getting on any of our lists or working with any of us, please reach out to each of us. So you can search by our names and you can track us down that way. Anyway, thanks again, gentlemen. Appreciate you guys being here. This is a great time, and hopefully I'll have you guys back on a future panel.
Thanks, Bronson.
Thank you.
Thanks for having us, Bronson.
Thanks, everyone.